Well, hello there. Let's get ready for our chapter 2 video lecture. You ready? Let's go. In chapter 2, we take a closer look at the balance sheet. The format in this chapter is known as a classified balance sheet. Now, the word classified means categories. With this form of the balance sheet, it still lists our assets, liabilities, and stockholders' equity, except now we have different categories of assets and different categories of liabilities. The equity section stays the same as what you saw in the first chapter. So now with the assets, we have what's known as current assets, long-term investments, property, plant, and equipment assets, as well as intangible assets. Your job is to understand the definition and meaning of these different categories and know which type of assets fall up under these different classifications. For the liability, we have current liabilities and we have long-term liabilities. You must know the difference between what are current liabilities compared to long. So this is a sample balance sheet and it's focused strictly on the assets section of the classified balance sheet. The headings deal with who, what, and when, the name of the company, the type of statement, and the date. And again, the balance sheet is always as of a specific date. It is not for a period of time. So notice we now have the different groups: current assets, long-term investments, what we call PP&E, as well as intangible assets. And for each of those categories, they're going to have their own subtotal shown on the classified balance sheet. And when you add these subtotals all together, it'll give us the total assets on the balance sheet. Let's take a closer look at what it means to be a current asset, long-term investments, property, plant, and equipment, as well as intangible assets. We then look at the liability section of the balance sheet, where we have the current liabilities and we have the long-term liabilities. And once again, each category has its own subtotal listed on the classified balance sheet. You're going to add those together to get the total of your liabilities. The equity section stays the same. It shows common stock. It shows ending retained earnings. And if I look at the total of my assets, which is here, the balance sheet still must balance my assets equal my liabilities plus my stockholders' equity. Current assets are assets that must meet one of these qualifications. It is an asset account that A, is in the form of cash already, or we expect to convert into cash within 1 year or within an operating cycle, whichever is longer. So again, current assets or asset accounts that a company expects to convert into cash or use up within 1 year or within one operating cycle, depending upon which is longer. So the question now becomes, what we mean by an operating cycle? Well, this is the average amount of time it takes to go from buying inventory to selling a good to collect from the actual customers. So we're saying if I'm selling a product, from the time it takes me to go buy the inventory, sell the inventory to the actual client, and then receive the payment from the client. Typically, the operating cycle for most companies will be within 1 year, but based upon the type of product, Sometimes a product had to be manufactured by the actual company. The operating cycle could be, say, 18 months. So if that's the case, to be a current asset, it would be asset account we expect to convert within 18 months if the operating cycle was longer than 1 year. So let's break this down. What type of assets do we expect to convert into cash? Well, any type of short-term investments. If I buy stocks and bonds of other companies that I expect to convert within 1 year, it qualifies as being a current asset. Receivables, account receivable, no receivables. Receivables shows money owed to the business. If the money is to be collected within 1 year or within one operating cycle, it qualifies as a current asset. Inventory. Well, the inventory is purchased or manufactured. We plan to sell inventory and then convert it back into cash. So inventory qualifies as being a current asset. It also says an asset that we're going to use up. Think about your prepaid expenses, whether it's prepaid rent, prepaid insurance, prepaid advertising. These are really expenses that have been paid for in advance, which cause them to be prepaid expenses. However, as long as the prepaid expense will be used up within 1 year or within one operating cycle, it qualifies as being a current asset on the balance sheet. So here we have Southwest Airlines, and we have a illustration of their current assets. They have cash and cash equivalents, short-term investments, account receivable, inventories, prepaid expenses, and other assets. So this is the current assets section of the balance sheet for Southwest Airlines. Next up, we have long-term investments. When you think about long-term investments, if I purchase stocks and bonds of other companies, keyword being that I plan to keep for longer than 1 year, it qualifies as being a long-term investment. But again, if we are coming by stocks and bonds of other companies, and the intent is to keep those items for more than 1 year, it qualifies as a long-term investment. Or if I purchase land or buildings that's not currently being used for operations, but the goal is to keep these items and to sell at a later date. So perhaps we're going to buy land now because we feel that the value is going to appreciate over time and that we can sell it at a profit at a later date. That qualifies as being a long-term asset. The key is the land or building cannot be used for operations because if so, they go up under a different category. So this is when we acquire land or building with the intent to sell them at a later date because we feel that their value is going to appreciate. Long-term notes receivable. So if a client owes us money and the due date is longer than 1 year from our balance sheet date, it qualifies as being a long-term receivable. We have a sample of the Google Corporation under their long-term investments. They have non-marketable equity investments, and it shows the amount in millions. This is showing the long-term investment section of the balance sheet for Google Incorporated. Property, plant, and equipment assets. These are what we call tangible assets that are being used by the company for operational purposes. It can include land, building, equipment, etc. These assets, except for land, go through a process known as depreciation. What is depreciation? It is a system put in place of allocating the cost of long-term assets over a number of years, which simply means that the cost for this building, equipment, delivery vehicles over time, the cost of these assets becomes an expense through a process known as depreciation. You'll learn more about depreciation in chapter 4. We're going to cover this concept in greater detail. Each of these long-term assets, except for land again, the building, equipment, delivery vehicles, they each have a contra account that's known as accumulated depreciation. Accumulated depreciation is a contra asset account that shows how much of the asset's cost has been depreciated or become an expense thus far. So as an example, here we have Tesla Motors, and this is showing the PP&E section for Tesla Motors. So they're showing all of their tangible assets, machinery, tooling, leasehold improvements, building, land, computer software, construction and process. Then they have a contra account. See, it says less accumulated depreciation, and it shows the total, which is subtracted from this amount to the total of our plant and equipment assets. So when you have the contra account known as accumulated depreciation, it is subtracted from the totals to get the amount for your plant and equipment section. Last, we have what's known as intangible assets. These are assets that do not have a physical substance. Go back. But we're saying, well, what makes them assets? They're called assets because of the rights and privileges that you have as being the owner of these intangible assets. Meaning that if I have a patent on a certain product, no one can copy my product during the life of that patent. So that gives me an advantage over my competitors. Or if I have a trademark or a trade name. So Nike has, of course, a trademark and a trade name. No one can use the Nike trade name or a trade symbol without their permission. And if Nike doesn't also use their trade name or trade symbol, you best believe there's going to be a cost tied in to doing that. So with these intangible assets, it's not about their physical substance, but when you own these intangible assets, you have certain rights and privileges, which give these intangible assets value. So here we have the Walt Disney Corporation, their partial balance sheet, and upon intangible assets, they have copyrights, they have franchise, they have trademarks. So you can't just go around putting Mickey Mouse on your products because that trademark belongs to the Walt Disney Corporation. Goodwill, we'll talk more about goodwill in a later chapter, but goodwill is also an example of an intangible asset. I think I'm going to stop there for this first section of the slideshow or this first presentation because we're about 13 minutes in. I don't want to make it too long. So I'm going to come back with a second video and cover the liabilities and the stockholders' equity section of the classified balance sheet. Okay, stay tuned.